Joining us now, Stephanie Link, Chief Investment Strategist at Hightower and a CNBC contributor. Kind of well telegraphed, maybe. This was out there, wasn't it, Steph? And but still, some interesting moves in other markets like gold or the dollar index. So it wasn't totally in the markets.
Well, yeah, I mean, it was expected to be a soft number, and it was a soft number. We're certainly making progress on inflation. And at the same time, Joe, the economy is holding up, especially on the consumer side of things, which is 70% of the economy, of GDP, especially when you look at housing and auto and services. And so that's good. That's good news, right? It is a soft landing, like you've been talking about for the last half hour. We'll see, because we still have to wait on data coming up. I mean, there is this lag effect that we've been talking about in terms of all the Fed hikes and what that's going to mean to the economy down the road. But for now, it is soft landing. The Atlanta Fed GDP now is at 2.3%. And I think all of this is going to translate into a little bit better on the earnings side of things. And this broadening that we've seen in the marketplace is much more healthy than what we had seen in the first half of the year.
But why fight it? Why not buy the Magnificent Seven if we're almost done raising rates? I mean, they're great companies, great growth, and there's momentum.
Yeah, I think you certainly can own some of them, but I think the valuations are not exactly cheap, and they're not exactly undiscovered. So I'm looking for other parts of the market where there really is value out there and where I think the expectations are really low.
Okay, so what would you be dabbling in today?
Yeah, so, I mean, this one is really ugly. It's 3M. You know, you guys have talked about the industrials and how they've actually done quite well. Well, 3M has not done that well. It's down 15% on the year, and it trades at 12 times earnings. Joe, there are 0 buys on this stock from the sell side. And that is very interesting to me. And I'm sure that investors on the buy side certainly don't own it as well. But look, they were making progress on the water contamination settlements. There's more that they have to do, but that was good news. It was less than expected in terms of the dollar amount, and it was more comprehensive. We still have to get through the earplugs issue too, and settlements there. However, I think that once you start doing settlements, history suggests that the stock starts to rebound. If you look at Bayer and Monsanto, that's exactly what happened. And so they also have a restructuring, and then they have a spin of their healthcare business later on this year or maybe early next year. So I actually think that that's positive, and I think, again, kind of off the radar screen.
Do you have a couple more, and we have some time?
Yes, we have American Express is one that trades at 12 times forward estimates. Their long-term growth rate for earnings is 15%, total revenues of 10%. And I like their mix. Their mix is 80% of their revenues are fee-based, and 20% is net interest income. I don't really want to have exposure that much to net interest income because we know it's going to be weak this quarter, given where the yield curve is at. So I like the mix. I like their size and scale, especially with the affluent consumer and small, medium-sized businesses, and the return to travel and the return to business travel. So I like this one. It's up 18% on the year, but I do still like it. I think the valuation makes a lot of sense.
All right, I want to do one thing before we go and leave today. So that's going to be it, Steph. But thanks for the quick analysis. 3M and American Express.